And we are continuing our program with having with us Mr. Daniel Bunn, Vice President of Global Project Tax Foundation. Thank you for being with us, Mr. Bunn. Mr. Bunn will present us a short overview of the 2021 International Tax Competitiveness Index. We are looking forward to hear from you in the next 8 minutes of this presentation. Please go ahead. Thank you.
Thank you so much. It's a great pleasure to be with you, especially virtually here in this day and age. I'm going to be talking about the 2021 International Tax Competitiveness Index, which was one of the main publications of the Tax Foundation, which is a think tank based in Washington, D.C. I'm going to go ahead and advance my slides. I'm not sure if you are able to see them, but here we go. So the index builds on two principles of tax policy, and the goal of the index is to compare tax systems across the OECD on principles of neutrality and competitiveness. Does the tax system create a lot of distortions or complexities? And relative to a country's peers, does it keep marginal tax rates low? Does it make it an attractive jurisdiction for workers or for businesses? And we look at 5 different areas of tax policy. Corporate taxes, individual income taxes, consumption, property taxes, the treatment of profits earned overseas. And we try to collect, we do collect more than 40 different variables, information on tax systems in the OECD, put them in our rankings to be able to see where the best and worst tax systems are. And it's interesting that Europe is actually home to both the best and worst tax systems in the OECD. So here are 2021 ranking results for Europe. So you can see that we have both the best countries. You can see Estonia and Latvia at number 1 and number 2, and also some of the worst with France, Poland, Italy, down towards the lower end of the index. And you could probably see Greece there at rank number 29. Now, one of the things that we find in this index is that countries that do well on these ideas of competitiveness and neutrality and these principled approaches to designing tax policy, and of course, the way the tax system is designed and whether it's favorable to the tax administration being able to collect revenue. These are the top 5 countries. And a lot of times they're in the top 5 because they have broader tax bases, relatively lower marginal tax rates, simple systems. They don't have layers and layers of different taxes that companies or individuals might have to comply with. But they're broader base, generally flat tax systems that are attractive for both businesses and often attractive for individual workers. Now, at the other end of the spectrum, you have countries like Mexico, Portugal, France, Poland, and Italy that I've already mentioned that have very complex tax systems, large burden on compliance, large burden on investment and workers, and multiple layers of taxes. So if you're, an individual or a household, you might have to comply with 3 or 4 different types of taxes in order to be able to pay what the government expects. Or if you're a business, you might have to pay capital duties or a digital services tax or these extra taxes in addition to the standard corporate income tax. And all these layers create new complexities and new costs for compliance that can harm the ability of a country to attract businesses or attract workers or create just a sustainable revenue environment for spending programs that a country might want to fund. Now, to zoom in a little bit more on Greece, again, Greece's rank in this index is 29th. I'll show a slide in a minute how Greece's rank has evolved in the index since the index first began in 2014. But here are some highlights, I would think, and some lowlights of the Greek tax system. And I think some of these things are very important to think through in this current context, where countries are recovering from the economic crisis from the pandemic and thinking about changing the tax system in a way that's maybe more sustainable from a revenue standpoint or sustainable even from an environmental standpoint. So one of the things at the top here is strict limits on loss carry forwards. Among OECD countries, Greece is one of the least generous countries when it comes to business loss carry forwards and the tax treatment of those loss carry forwards. And this is particularly important for businesses that have experienced significant losses during the pandemic, or businesses that are startups and running losses as part of kind of their business cycle before they're able to bring a product to market that's profitable. On value-added tax, Greece has a relatively high VAT rate compared to other countries with VATs, but a narrow tax base. And now that narrow tax base has multiple issues that are contributing to that narrowness. There's policy decisions that create carve-outs and exemptions or special rates. There are also compliance issues that narrow the tax base there. But generally with value-added tax, you want to create a broad base that doesn't distort individual decision makers between different types of goods, whether certain groceries are exempt or not, whether certain activities receive a special rate or not. Oftentimes, policymakers want to provide special rates or carve-outs from VAT because they want to think about lower income people or folks that have less purchasing power. But the VAT is often a tool for significant revenue that you could channel some of those social policies through different parts of your government rather than trying to use a weird tool like value-added tax to create some of those equity issues. Now, Greece also has limited deductions for machinery and equipment relative to other OECD countries. A lot of countries recently, like the US, like Canada, like the United Kingdom, have provided significant advantages for companies to deduct costs related to machinery and equipment. I'm familiar that Greece does have some narrow accelerated depreciation rules for green investments, but I think a lot of times policymakers think about what they think is green, and that may not match up with what might be a sustainable investment for businesses. And a lot of times being able to provide accelerated depreciation, both in the context of an economic recovery from the pandemic and in the context of businesses looking to upgrade their machinery to be more efficient, is important for this kind of green transition and the economic recovery. Low tax rate on dividends, of course, is a benefit to savers and shareholders. And that's something that is kind of one of the highlights of the Greek tax system. Now, just one of the fun things about the index is you can run various scenarios through it to be able to think of what if something changed, how would a country's rank improve? And in this, I show not only the evolution of Greece's rank, where Greece has improved over the last few years, to 29th from 33rd place. But if Greece was to remove limits on loss carry forwards, adopt accelerated depreciation or immediate expensive for plant and equipment, be able to expand the VAT base a bit and reduce the VAT rate to 23%. And I realized I didn't advance the slide there, but now you can see what I was talking about. That Greece's rank could improve to 23rd. So this is showing that the index is really a tool for policymakers and folks studying the tax system to see where the variables are, where the country stands relative to its peers, and if something were to change, or if something should change, what those changes might be reflected on in the index as far as the rank improvement. And with that, that's a summary of the International Tax Competitiveness Index. I believe there are going to be a few questions, but that is it for my presentation. Thank you.
Thank you, Mr. Bunn, for your short overview. I have two questions for you, if we can go fast on those.
Yes.
First of all, do you expect recent measures for climate to affect the index for some countries, and how?
So the index is not a perfect tool, but it is a broad tool, and we do not currently include climate change policies in the index. However, as I was mentioning, some countries have decided as part of their package for the green transition to provide incentives for new investments, for shifting the tax base away from certain areas and towards another area. I think Austria is a good example. They have a tax reform proposal to reduce the corporate tax rate, to change some taxation of individuals, and bring in a carbon tax alongside all of that to kind of replace those revenues. So some of those changes would be reflected in the index. And it's possible that in the future, we're always looking at this tool and seeing how it can be improved, that we might be able to bring some of these climate tax policies back into the index to be able to evaluate those on an apples to apples basis as well.
Thank you. And my last question is, does Greece need to widen its tax treaty network?
I think the tax treaty network is an important variable. It's something we look at in the international index. Greece's treaty network is relatively narrow. And I think broadening the tax treaty network creates two opportunities. One, an opportunity for foreign businesses to invest in Greece and know what the tax rules are going to be for when those profits get attributed back to shareholders in the home jurisdiction, but also for Greek companies that are looking to sell elsewhere and expand their global footprint. I think having that tax certainty and knowing what the rules are when you're engaging with a foreign tax administration, knowing that your government has already engaged with that foreign jurisdiction to set up the right rules for the process of a multinational and where it owes taxes. So I think that's an important thing.
Well, thank you very much, Mr. Bunn. We're looking forward to have you physically in the next hour, in the next forum, actually, and we appreciate being with us. Ladies and gentlemen, we are now proceeding to the next and final discussion conversation.